Welcome to Verney Tax Law. This is the first part of a series of videos dealing with offshore disclosures and financial reporting. Today we're going to talk about the FBAR provisions which originated in the Bank Secrecy Act under Title 31. While the FBAR penalties are authorized in Title 31 rather than Title 26, which is the Internal Revenue Code, the authority to assess these penalties has been delegated to the Secretary of the Treasury and in turn to the Internal Revenue Service. Essentially, the regulations provide that any United States citizen who has a financial interest in or signature or other authority over a bank, securities, or other financial account in a foreign country to report certain details about the account to the Treasury Department. The report must be filed with the Treasury Department, specifically the Financial Crimes Unit, no later than June 30th of each calendar year with respect to any foreign financial accounts that exceeded $10,000. The form is known as FinCEN Form 114, commonly referred to as an FBAR. For violations that involve non-willful failure to report the existence of a reportable interest in a foreign financial account, the maximum amount of the FBAR penalty that may be assessed under Title 31 shall not exceed $10,000 per year for up to 6 calendar years. However, no penalty shall be imposed if such non-willful violation was due to reasonable cause and the amount of the transaction or the balance in the account at the time of the transaction was properly reported. The reasonable cause exception does not apply to the willful FBAR violations. In order for the government to prevail in the assessment of an FBAR penalty, they must prove that the taxpayer was either a citizen or a resident or a person doing business in the United States during the relevant tax year. They must also prove that the taxpayer had a financial interest in or signatory authority over the foreign financial account. The foreign financial account also has to have had a balance that exceeded $10,000 during the relevant tax year. In addition, the taxpayer must have failed to disclose the foreign financial account, and the imposition of the penalty was proper under the circumstances. Additionally, where we have a willful violation of the FBAR provision, the government is tasked with proving that the violation was willful, in addition to the other elements we just talked about.